Is there a way to play this volatility? Hi, everyone. Welcome to the Real Vision Daily Briefing. Joining me today is Jem Carson, founder of Kai Volatility. Hi, Jem. How are you?
Hey guys, good to see you.
It's fantastic to have you on. I think the first time on the Daily Briefing, and we're lucky because you're a longtime macro person. You're an expert in volatility, and boy, we've got these are pretty turbulent times we're in. So, maybe let's just start out broadly and give me a sense of what's top of mind for you as we look around the world and we see what's happening in currencies. I mean, the yen at a 24-year low today. We have the UK government bond market all over the place, off the Bank of England, and it's once again today in turmoil. So, what are you looking at as you look across the global economy right now?
Yeah, I mean, you can't start a conversation about macro in this environment without talking about inflation, right? I think that's where we have to start. I've been saying this for going on 2 years now, but the reality is that inflation and the inflation that we're seeing is a function, and we've seen this throughout history, of a rebalancing of inequality, right? Of a people caring about the inequality that the Fed has created over 40 years. We started seeing this about a decade ago with Occupy Wall Street and the Tea Party and whatnot, but it took a while. It took the right coming left and the left going even more left with Bernie Sanders and Donald Trump, right? And then it took a spark, which was COVID. So all that fiscal policy, an order of magnitude more than we've ever seen, paired with all the knock-on effects that come with that, which are competition game, global competition over resources, whether those resources are commodities, whether those resources are cash, right? Cash is getting more expensive, or labor. All of those things, drive protectionism, drive competition, et cetera. So that's the framework where we'll start. I know that's a big picture kind of way to start about to talk about now specifics. That inflation, unfortunately, is not going away. It's structural, and these things we've seen, and that's the big takeaway. It's not transitory. We've been saying that for 2 years. It took a while for other people to catch on, but the reality is that's the truth. And not only is it structural and not going away, the Fed's attempt to control structural inflation with cyclical measures is not going to work. It'll work in the short term, but they can't control structural inflation with cyclical measures. They can slow short-term cyclical inflation. And ironically, trying to deal with structural inflation with cyclical measures ultimately drives worse structural inflation. And I think that's a big, important takeaway that a lot of people are missing. For 40 years, markets have operated where people just think about cyclical inflation. That's it. Structural inflation hasn't been part of the story. So it's easy for people to just say, hey, look, if the economy slows, if we go into recession, right, inflation's going to slow and we're going to solve this problem. Because that's how things have broadly worked in a controlled monetary policy driven economy. That's not where we are. That's not what's happening. And again, as I've expressed many times before, cyclical measures are going to make it worse. What do I mean by that? Why are cyclical measures by the Fed, attempts to slow down the demand side of the economy, going to make things worse? Quite simply, monetary policy, which is the only tool the Fed has, is a supply side economic measure. And what do I mean by that? When you lower interest rates, when you do QE, you send money to capital. You send money to capital markets, you send money to corporations, you send money to wealthy individuals. You do not send it to people at the bottom who spend their money. You send it to people who invest. All that money ultimately, or like the overwhelming majority, flows to corporations. That is a supply side economic approach. What does that do? That means corporations can produce more things. It drives globalization, it drives technological innovation, it drives competition, right? All the things that we saw for 40 years that were ultimately deflationary. The more monetary policy we did, the more deflation we got for 40 years. I talk about this as sending money to planet Palo Alto, this wonderful, right, planet on the other side of the galaxy, yeah, which is and again, I'll keep using that because it is a great picture, but we're sending money there. The velocity of that money is zero. It's not entering our economy. It's entering, the powerful, all-knowing people of planet Palo Alto's economy, and they send back to our economy goods, supply. This is why it's supply-side economics. And that supply is ultimately not inflationary, shockingly. It's deflationary, right? Because we're creating Teslas and Ubers and Amazons and all these wonderful innovations which reduce the need for labor, which ultimately provide more supply on the market. So ironically, we've been doing monetary policy full force for 40 years, and we've created structural deflation by doing it. And now we are pulling that money away in order to create a cyclical slowdown, but structurally that's going to cause more inflation, right? Because we're doing the opposite of supply side measures, which is what we actually need. Ironically, we need structural supply to meet the demand that we've been driving. So through all these fiscal measures, and so we're not meeting demand with supply. We're doing the opposite, and so we're exacerbating structural problems. That also exacerbates problems because the more money you take away, not only do you slow technology and supply, but you reverse globalization broadly from a more structural perspective. Again, that protectionism, all those things. And then the last knock-on effect, you actually increase, for the one thing that does directly affect the middle class on down, which is the cost of housing. You increase the cost of housing by increasing interest rates, because ultimately rents, as we've been seeing, increase as you increase interest rates because people can't afford to buy homes anymore. So the housing part of inflation has been structurally going higher, and everybody seems shocked by this. How is this housing? How are rents not coming down given that we're increasing interest rates? Because people can't afford to buy homes, so they have to rent. So, and there's a supply-demand imbalance. So there's structural exacerbating forces by raising interest rates the way we are to cyclically slow things. And again, we dove right into kind of the big picture, but that's the big takeaway, and that's the important kind of thing for people.
Important. We do a takeaway usually at the end, but I love front loading because if it's really important to understand. And by the way, like if I had a mic, I would just drop the mic right now. A really, really masterful explanation of, I think, why we all intuitively feel like policymakers are screwing up. Like we sort of, everyone keeps saying, like, I don't understand. Why do they have to, destroy the economy and kill us in order to get inflation down? And it doesn't look like it's working anyway. Like people sort of can understand that on some intuitive level, but that's a really sort of helpful framework for us to think about why it doesn't appear to be working and why we're sort of starting to see all these strains. So let me ask you something. I think this addresses one big issue out there. So when you were talking about Planet Palo Alto, Silicon Valley, for those of you maybe or don't know the zip code, but when we have easy money, we heard all the time, and this is, I think, what sucks people into thinking that somehow Fed policy is going to be able to right the ship here. We had this era of easy money. We're just throwing money out the window into the economy, and everybody gave everybody these government benefits, and we're just flush with all this cash. And now they've got to tighten things up and suck it out. The way you just described that does not sound like money circulating in the real economy.
Yeah, I mean, look, at the end of the day, that will slow, these effects will slow demand. I'm not saying that they won't slow demand, but it's all a function of how much you're affecting things cyclically, like in the short term, versus what you're doing structurally. And we're not solving the problem, we're actually making it worse. We saw this in the 60s and 70s. This is not just speculation. This is not me playing with a toy model. This is what happened in the 60s and 70s. It started with the Great Society program with LBJ. We tried to do cyclical measures. People always talk about William McChesney Martin and Arthur Burns being kind of asleep at the wheel. But, and I've said this before, but, William McChesney Martin increased rates by 7.5%, Fed funds rate by 7.5%. Arthur Burns, who everybody kind of lambasts as kind of the one responsible for continuing structural inflation, raised Fed funds by 10.5%. The reality is those things ultimately made the problem worse. It drove more populism. Why did it make it worse? It made it worse not just for the reasons I mentioned before, but the more inflation we see, more structural inflation we see, the more people on the bottom who are driving these structural effects are hurt by inflation. The more fiscal policy, the more demand on politicians we have, and the more international strife that we see. Again, people think the OPEC crisis of the 70s, right? the Vietnam War, the fiscal policy we saw, all of these things were inflationary pressures, but they're all independent events, everybody thinks. Isn't it weird that we're starting to see the same things over again? Probably not a coincidence, right? Why are we seeing war? Why are we seeing those with power in the commodity markets flexing their muscles? Right at the same time, we're seeing populism and inflation because these things are all connected. They're all connected. When you go from a cooperation game, when the elites and the powerful corporations have money, and you're doing trade across countries that people aren't. There's no resource scarcity. Everybody's working together. It's a cooperation game. But the second we start worrying about inequality and the people at home want things fixed, right, for themselves, they want more, labor wants more power, they want more say at the table, we want to rebalance these things. Now you're in a competition game. Now resource scarcity, like I mentioned, commodities, labor, money, all these things everybody's scrambling to get. And that drives a time when weak countries feel an existential threat and need to do actions like we're seeing in Russia, like we're seeing in China, right? Because they feel that they're threatened. And then it's a time when we see those with the resources and the inputs being able to now, given bifurcation, flex their muscles a bit and really have sway over the situation at hand. So we will continue to see commodity, as we saw. And again, we've called for all these things. This is not me saying this ex post facto. Like we said, expect OPEC to flex their muscles. The SPR is bleeding dry. They have more leverage. We're in a bifurcating economy, world economy. Guess what? You look at incentives, you see results. Well, the incentives are that these entities have more power in this competition game, and they start to do these things. Why are Russia and China the ones that are again trying to push back? Why do they feel so threatened? Russia and China happen to be the two countries with the biggest demographic structural problems going forward in the next 20 years. China's probably going to drop by about 500 million population in the next 25 years or 30 years, from 1.2 billion to 700 million. They're becoming more and more dependent on, given that shrinking of technology and manufacturing know-how at a time when they don't have those things. They also don't have the inputs they need to manufacture. So hence the alliance with Russia and again, the things that are happening there. So it's a much bigger picture. I don't want to oversimplify things, but it's important to look at these trends and understand why they happen. And I'm referencing the 60s and 70s. This is not the only time we've seen this, right? We saw a similar thing during World War II in the 1930s. There's repeating cycles throughout history as a function of these two things. But the driving forces are capital versus labor, natural competition, which is kind of natural selection, free market economics, whatever you want to call it, and against it, pulling against it, this idea of equality and fairness and populism. And from a philosophical perspective, those things, the left and the right, have been in opposition since time incarnate, and those things continue to drive big major cycles. And it's more than just cyclical, right? Can we slow down the things in the short term or speed them up? These are structural effects that have to do with balance between these two major powers.
Absolutely. So we have a great question. We've got great questions coming in, and I want to try to weave some of them in right away. If you have one, you know the drill, drop them in the YouTube chat, in the comment section on our website, or you can Twitter at AskRV. And I'm already going to say we're never going to have enough time we're about the layer, but we're going to have Jem on again. But let's scratch the surface here. We have a question about if you, from Francisco on the RV site, is there anything that can break the trend of populism? If this swing, with the inequalities and swing to populism is what's part of what's feeding into the response to that, feeding into structural inflation. Francisco's asking, can anything break the trend of populism? How do demographics play into the inflation framework? And I would add, if the Fed doesn't have the tools to address this, who does?
Yeah. So let's start with how do we stop this? Look, these are structural, big cycle things. These are multi-decade long structural things. This inequality has been built over 40 years. You can't just go snap your fingers and fix inequality. If you can speed it up. you're going to get a bigger crisis sooner. And then, so you can either do it over time and do it gradually, or you can do it all at once. But there are problems with each approach. It's not a straight line, so there's a lot of things that can happen 1 year, 2 year in between to bend that trend. To that may, like I said, elongate it in some ways while making it worse over the long run, or shorten it and make it less bad over the long run. So there are ways to affect these trends, but they are major forces that that we have to contend with if we want more equality. And so that's the big question. If we're willing to just be raw in tooth and claw and run, when I say we, I mean the populace, right? The people who ultimately in a democracy have that decision. If we were an autocracy and we said, well, we don't care about the people, right? We have absolute control, free market economics on steroid again, let's go. We could avoid this. We'd ultimately make it worse. And in those general situations, that leads to that's basically let them eat cake, which eventually leads to something bigger in another way historically. But we have a democracy, so these are pressure, the releases of pressure. So we don't have revolution in theory. So given that we're in a democracy here and that populism, the people are turning to populism, I think it's going to be hard to avoid. We can affect things on the margin, but changing it altogether after 40 years of increasing inequality, and not just slightly increasing inequality. If you look at Gini coefficients, we're at record levels of inequality, and we understand why that is as a function of monetary policy. So that was the first question. Your second question, now I lost track. What was your second question?
How can I asked you like three at one time? So the second question was Francisco asking about demographics.
Oh yes, critical. Demographics is destiny, right? You've heard that saying before. 100% truth. That is, much like inequality. These things are they are measures that are important. They ultimately drive certain incentives. Demographics, direct input to supply and demand, obviously, and the baby boomers are dying off. In the U.S., the millennials, which is the next bubble, are coming to their prime ages of production and household formation. That's a critical part of this. The millennials, it's not just because of the bubbles demographically, but it's about who these people are and who they've become as a function of the cycle they went through. And the cycle that the millennials went through is a time of technological revolution driven by free money, a time of massive inequality, so a feeling of things aren't fair. You look at, during the 60s, what was the big thing everybody's talking about? Equality and equity. Guess what we're talking about this decade? Equality and equity, because the millennial generation has been in a broad time frame where they were labor, they didn't have the capital, and they've been falling behind. They're at 40% of where the baby boomers were at this time in their lives in terms of wealth and household formation. These things lead to a feeling of, hey, this isn't fair. This isn't just, and so that generation overwhelmingly is driving populism because they feel that this system hasn't been fair. So it's not just the demographics of demand and supply, which is important because you have a bubble of people who are at the 40th, at 40% of where the baby boomers were, now entering their prime spending and buying years. But they're also behind, right? If you're at the 40th percentile, you have a lot of catching up to do in order to get to where you need to. And so they're demanding help from government to help catch up. And so, big demographic bubble coming to their prime spending years as they need to catch up is a demand, is a demand push. And it also importantly drives this populism we're speaking of and this rebalancing. So absolutely, demographics has everything to do with it. It's important to, though, note that age is also, a function of class. So, the labor class and the younger generation are one and one because people, when they come out of college, don't have money. They're not the capital class. They are the working class until they build their capital base. So again, it drives a lot of other trends. And I've talked about this too. I don't want to get too deep into this, but Bitcoin, right? Everybody's like, oh, Bitcoin, it's a revolution, et cetera. I'm like, fine, but why Bitcoin? Like we could have gone, the millennial generation, that younger generation could have gone anywhere. because this generation has been marked by a period of unfairness that's driven by monetary policy, a feeling of technology can solve all of our problems because they grew up in a time of technological revolution, and a need to catch up. So speculative assets like calls and YOLOing, Bitcoin, cryptocurrencies, speculative assets. So like it makes a ton of sense if you just look at who these people are, why they are in the situation they are, and it's a function of the cycle and the system. And so demographics is 100% a major driving force of this on many, many levels.
So I just want to pause for 1 second to really just underscore that when you're looking at markets, and I think this is what we've been trying to drive home on what we're doing on the platform and why we're bringing guests like Jem on to the daily briefing, is that to be able to make decisions about your investments, you have to have a view on this larger framework, right? So Jem's laying out about how he feels about populism, why he thinks inflation is structural. The bets he makes are going to be within that framework. So if he's viewing things like Bitcoin in that way, that's going to influence what he's. I think that's so important to bring up, Jem, because otherwise you're just like swacking at the pinata without any idea, and it's hard to understand. I'm going to bring up an example. We have a question, Dr. Jane on Twitter. What outcome tomorrow does the commodity sell-off most align with? I'm thinking a low print. I'm thinking that she thinks because commodities sold off, they've got to guess about inflation. But there's a million other factors that are influencing what's happening in commodities as well. It's so complex. With that framework you just laid out, what do you feel positive about? What are you most concerned about in the global economy? Because it sounds like you think central bankers are just ham-fisted here, like they just not addressing the problem correctly. So are you more worried, more bearish than bullish, and what are you looking at?
Yeah, I think the big takeaway based on my view is that all of the narrative about recession, are we going to slow the economy? It's incredibly simplistic. It's two-dimensional. And it misses the broader multidimensional aspects of what's happening here. And so, yes, is the Fed going to ultimately slow the economy somewhat? Yes, via a trickle-down effect by slowing money to corporations. There'll be less employed people, but that effect relative to the other structural effects of more fiscal policy as the economy slows, right? As a reaction, again, less money to, less supply side, less supply in the economy, more geopolitical stress coming from this competition game. All of these things are in opposition to that. So ultimately, yeah, in the short term, we can slow, inflation a bit via a recession, but all of that is ultimately, if we have structural inflation, a side note to the bigger picture. The second we slow, the Fed will ultimately have to, call it a pivot or slow the rate of increases in interest rates as they achieve their goal of recession. But what we're going to see as a result when that happens, much like we did in the 60s and 70s, is inflation going structurally higher than, again, once higher than it was before, and long-term rates ultimately climbing, which then will drive more inventory build, more demand being brought forward, a lot of other things that will then take hold. The Fed is in along the steps right now of losing control of the long end of the curve. It will take a bit of time for people to kind of come to terms with this and realize this. But in the short term, they are trying to control a cyclical political short-term kind of CPI number, which is ultimately not what matters. Again, and my point is, what they do ultimately is a short-term effect, and we should be thinking about the big long-term, trends, which ultimately is what matters.
By the way, all of them are in Washington at the Bank, which has been interesting because they're sort of lobbing bombs from down there every time one of them speaks. We see the market sort of move really drastically. There are some people who say that they're just going to keep hiking until get inflation down. If they're not able to, it sounds like you think they're going to have to turn around and they'll inflict so much damage they'll have to stop and pivot. So
yeah, they're going to have to. Everybody again looks at Arthur Burns and says, oh, and William McChesney Martin, like, oh, they weren't strong enough. They didn't do what Volcker did, right? But the reality is they did dramatic things, and they both caused dramatic recessions. If you look at Arthur Burns in particular, he drove the biggest recession since the Great Depression in 74, 75. And it was such a deep recession. It was so unpopular that, yeah, the Fed had to stop. Yeah, at some point, you inflict enough pain on people and the economy. It's so unpopular. You are not going to be able to do more. There's just a limit to what the Fed can do, given the amount of pain they're inflicting. And when they do, given that they're not actually dealing with structural inflation, this demand push economy, which we're in and we will continue to be in for some time, will run hot. You can counteract how hot that economy is running cyclically for a while, but the structural strength of demand will just come back relative to supply in spades after that. And especially given commodities, which again, I don't want to dive too much into the commodity trade, but given how inelastic supply is, how little production, real supply, because again, of the underinvestment there that we've had for other reasons, that will ultimately drive a macro cyclical cycle for commodities, which will exacerbate things as well.
So are you bullish commodities from here?
Very, very.
Are you bearish equities?
Well, 68 to 82. And again, are we talking nominal or real equities? I think equities on a nominal basis over the next decade are going nowhere. So that doesn't mean we're going to crash. But again, 68 to 82, and we're not exactly there, but it's a good relative metric. There was just less demand for stocks because interest rates are higher, right? If you can go buy a bond at 20%, why are you going to go put your money in the market? The Tina effect, which everybody was talking about, is now in reverse. Nobody's talking about that. Not to mention, there's just less capital sloshing around in general for bonds or stocks. So now stocks are out of favor. Everybody talks about discounted cash flows and multiples, but the reality is that the PE multiple for the S&P has been anywhere from 4 to 40, and that can change by an order of magnitude, which it doesn't make for a very good pricing model, and fundamentally not a good metric for when to buy or sell stocks historically. The reality is during periods of inflation and higher rates, we see multiple contraction, and that is a function of just less demand, supply and demand, less demand for stocks. But when wealthy people have less money and people at the bottom have more money, it's not a supply side economic driven model. It's a demand side driven model, and that drives more demand for goods, which causes inflation, which drives a move out of money from the investment side. It's not rocket science, and we're likely to see multiple contraction. We're also likely to see a hotter GDP growth during the 60s and 70s during that period. And this is a perfect example. 68 to 82 for 14 years, we grew above trend in real terms, not just, the economy ran hot. It was a very healthy, strong economy. You don't hear about that. The market did awful. The market is not the economy. People confuse that all the time. I think we'll get margin compression over this period, right? Based on deglobalization, based on less technological advancement, based on all the things that went the other way during a supply side driven model. We'll get margin compression. GDP growth will actually hang in there relatively. Yeah, we'll have a recession here, but it won't be particularly deep, I don't think. And then we're going to continue to the price to sales will normalize based on inflation and broad growth. And guess what? We're rebalancing things, which things just went too far. The pendulum swings. That's what a cycle is. The pendulum swung too far, and now it's swinging the other way. Unfortunately, these time periods are more difficult. It's hard to invest. It's hard to, there's a lot more global strife. It tends to be a time of not just rebalancing in terms of markets, but a time of rebalancing in terms of policy. It's a time when countries actually, because there are bigger problems, solve problems. The U.S. Made a lot of changes in the 30s. It made a lot of changes in the 60s and 70s. Why? Because we were at war. There are crises, and we solved a lot of problems. And in the long run, that's a good thing. And it'll lead to the next eventual boom, as long as we don't blow ourselves up along the way, which is highly unlikely, in my opinion. But that's a positive note, but it's going to be a tough decade.
Well, we're going to end it on that positive note because it puts it in much more of a sort of historical, almost political framework. And I think it's so important for us to think about that concept of demand led economy and not a supply led economy. And so for some people, it may be not going to feel horrible if you were on the labor side of the equation. And I don't mean sort of unionized. I just mean, as you put out, like in part of the economy that's been feeling left behind. But I do think there are big. It sounds like you're saying there are big question marks globally. Like this is it is a very volatile time. As we leave out, and that's the takeaway I'm going to think about, and that we're going to keep talking about, is this sort of how this fits in. If you think about it from that perspective, your bullish commodities, equities may go sideways. What about bonds? Because there's sort of bonds if you're investing in them and are trying to sort of, think about rates. And then there are bonds for people who are, I don't want to say pensioners, but who just want to get that yield. How do we need to think about investing in bonds from the different class of investors?
Yeah, I mean, look, it's we're at the beginning of a macro cycle towards higher and higher rates. And important to note, the beginning. So duration is your problem. The duration is what will kill you, as we've seen this year, right? When you're looking at the bond market, yeah, I mean, I think there's a lot of ways underneath the hood to get, again, the curve is inverted. You can go get a 3-month, 6-month yield, and there are ways to use those bonds then as collateral against other trades as well. Not to get this too complicated, but you can generate a nice yield underneath other things that you're doing. And so, yeah, you should absolutely be doing that. You should keep your duration to a minimum because of what, again, based on my view, we're going to see higher and higher rates in that long term, and you don't want to be exposed to that. Yeah, I mean, bonds should, are a way to, again, generate a bigger inflation hedge to your portfolio, which you want to do. And you should absolutely do that. I think there are, other ways to do that as well. I think there are plenty. I want to be clear. I'm not bearish all stocks, bearish indices, in real terms. Discounted cash flows will matter again. I know that sounds crazy. After 40 years, you sound like the crazy man mumbling to himself in the corner if you talk about value. But the reality is cash flows matter. They put on a business, and that cash flow in the short term hasn't mattered when cash is free. But if you generate cash and are able to fund things when other people aren't, you can buy other corporations when you see creative destruction, and you can invest in things when others can't. You can buy back your stock, et cetera. So those corporations that generate cash flow that is positive in real terms in a demand push economy will benefit from higher sales, and the economy will do well. So invest in the economy. Don't speculate. It's a different type of market.
Jem, this was absolutely amazing. I love the conversation, and I think it was, really important at a time when we've got inflation today, tomorrow, and we've got the Fed and all these monetary, figures continuing to come out with these comments. I think it's really, really helpful way for us to think about, how to view the economy, and that the economy is different than the market, which is worth underscoring because
that's 101. I try and tell people that all the time, and the people, it just doesn't register. Everybody's taught that, DCF, the market is, the economy, but despite, evidence to the contrary at every turn. So, yeah, I think we'll get a strong demand push economy. All things considered, we'll have a cyclical recession driven by the Fed in the meantime. But over the long run, this is a very, very productive economy. We will see more production in some ways. You got to be in the right places where you're not getting hurt by deglobalization. You're not getting hurt by input costs and scarcity of resources. If you put yourself on the side of resources themselves, things that aren't subject to, that do well in greater consumer demand that's greater, particularly domestically. Onshoring here in the U.S., as we move away, there are plenty of opportunities. It's important to note, everybody's like, how do you invest if markets are going nowhere? Well, you don't just close your eyes and invest passively. You have to, active management matters again. I sound like the crazy guy mumbling to himself in the corner when I talk about active management. The reason passive investment came to be during this period is because markets just went up, because you had the Fed in your pocket. You could do 60-40, and it wasn't really important what alpha or what edge you had. Well, guess what? That's changing as money becomes more scarce. And so lots of opportunities when you're at the turn. That means there's an incredible amount of opportunity if you get the trends right. But it's not necessarily as easy as just putting your money in the market and going to the beach for a decade.
Absolutely. And we're going to try to actively help people sort of understand that and move them through the process because for some people it's been a generation. It's not something they've had to do. Jem, amazing stuff. Thank you so much. And we're definitely going to pull you on and do a deep dive into what that globalization looks like, what that demand push looks like, and how we can figure out how to sort of, optimize those opportunities. So thank you so much.
My pleasure. Thanks for having me. Look forward to coming back.
And thanks to all of you for the great questions. I know we just scratched the surface, but believe me, we will have him back on again to think about that and follow up with your questions. We'll continue to bring them up. We'll be here tomorrow with Weston and Jared Dillian. So until then, take good care.